Ready for a wild ride. Today, we're going deep into Black Monday, October 19th, 1987.
Yeah, Black Monday, a day that really threw the financial world for a loop.
We're going to break down exactly what caused this massive market crash and see how its impact is still felt today. So to set the scene, it's 1987. Think Dirty Dancing, the first lethal weapon. What was the economic mood like?
Well, on the surface, things seemed pretty rosy. The U.S. economy was in a growth phase, we were climbing out of a recession, and the stock market, specifically the Dow Jones Industrial Average, was hitting those record highs by August.
Okay, so you have this success story playing out, but were there any hints that maybe, just maybe, things were a little too good to be true?
There were some warning signs. The week leading up to Black Monday saw some pretty big market dips, almost like those little tremors you feel before an earthquake.
Uh-oh.
Some experts pointed to proposed changes in U.S. tax law that would affect corporate mergers and acquisitions, saying those were making people nervous. Others were worried about a big trade deficit announced on October 14th.
So some possible triggers emerging. But did those actually cause the crash?
Well, that's where things get interesting. Right after the crash, an economist, Robert Shiller, and he later won a Nobel Prize, by the way, decided to ask investors what they thought caused it. He surveyed almost 900 of them.
Wow, 900 investors, that's quite a sample size.
Yeah, and surprisingly, very few blamed those news events we talked about.
Really? Okay, so if not those concrete events, what were they blaming? What did they think caused it?
Shiller discovered this fascinating psychological element at play. A lot of investors admitted they had this sense of foreboding, this feeling that a crash was practically unavoidable, like a self-fulfilling prophecy, if you will.
So you're saying it was more about fear and speculation driving the market, not necessarily solid economic news?
You got it. It's like when you're in a crowded room and suddenly everyone gets the urge to leave at the same time. People start reacting to each other's fear instead of thinking logically.
Yeah, it's like a herd mentality taking over. And this noise, as you call it, was amplified by some of the financial tools of the time, right? Because by 1987, Wall Street was getting pretty complex.
Exactly. By then, you had these things called derivatives, which are essentially bets on whether stock prices will go up or down.
Yeah.
You've got futures, options, different types of derivatives, but they all involve speculating on the future price of an asset, like a stock.
So almost like side bets on the main game of the stock market. But how do those side bets actually impact the main game, the actual stock market?
So usually the derivatives markets and the stock market move in sync, influencing one another. But on Black Monday, things got weird. They became decoupled.
Decoupled?
Yeah, so that morning, trading in the actual stock market was delayed. Too many sell orders, everyone trying to get out at the same time. But the futures market, which trades those derivative bets I mentioned, that opened on time. And it opened way down, reflecting all this panic and fear.
Oh boy. So you have one part of the market reflecting sheer terror, but no actual stock prices to confirm or deny those fears. That's not good.
It was a recipe for disaster. The normal ways of figuring out what stocks were really worth, they were thrown out the window.
Oh.
And unfortunately, things were about to get much, much worse.
Okay, so you've got this underlying sense of dread, these potential triggers, fear, and speculation are running wild, and now the derivatives market is going haywire. How does this all culminate in a full-blown market crash?
Well, remember that investors, especially big institutions, they use strategies to try to, manage their risk. And in 1987, one really popular strategy was called portfolio insurance.
Portfolio insurance. That sounds like a good thing. It's like a safety net, right?
It was supposed to be. Basically, this portfolio insurance, it was a computerized system, and it was designed to limit losses by automatically selling stocks when prices dropped. The idea was to prevent those huge catastrophic losses.
Makes sense. But what happens when everybody tries to use that safety net at the same time?
Exactly. It's like if one person leaves a crowded theater, no big deal. But if everyone panics and rushes for the exits.
You get a stampede.
Right. And that's kind of what happened on Black Monday with this portfolio insurance. These automatic systems, they all triggered at once, leading to a massive wave of selling, driving prices down even further, which in turn triggered even more selling. A vicious cycle.
It's like a snowball effect, just getting bigger and bigger.
Absolutely, a financial avalanche.
And this was happening at a time when lots of people were buying stocks with borrowed money, right? So did that make things even worse?
Yeah, buying on margin, as it's called, was pretty common. Essentially, you're borrowing money from your broker to buy more stock than you could afford outright. And if the stock goes down, Well, that's when you get what's called a margin call.
A margin call, what's that?
It's basically your broker saying, hey, you need to put up more money to cover those potential losses. Like, let's say you bought a stock at $100. You only put down $50 of your own cash and borrow the other $50 from your broker. But then the stock drops to, say, $40. Your broker's going to get nervous. They don't want to be left holding the bag, right? So they issue a margin call demanding you put up more money, maybe another $10, to make sure you can still cover that loss.
So the market's forcing you to cough up even more cash precisely when you can least afford it.
Exactly. And on Black Monday, margin calls were happening everywhere. Individual investors, sure, but also huge financial institutions. They were getting slammed with these margin calls, forcing them to sell whatever they could, driving prices down even further just to stay afloat.
Everyone's trying to sell, no one wants to buy.
It was a liquidity crunch of epic proportions. The market was in free fall, investors were in full panic mode, and it seemed like the whole financial system was about to collapse.
So everyone's scrambling, trying to unload their stocks. Fear is gripping the markets, and it seems like we're on the verge of a total financial meltdown. What happens next? Did anyone or anything step in to stop the bleeding?
This is where the Federal Reserve, the U.S. Central Bank, they come into play. They saw what was happening, and they knew they had to act fast or things could have gotten really, really bad.
So the Fed steps in to save the day. What did they do?
Their main tool in a crisis like this is liquidity, getting cash into the system. Imagine a fire hose dousing a raging fire. That's what the Fed was trying to do. Flood the market with money to reassure everyone, the banks, the investors, that the system wouldn't just run dry.
Okay, so a massive cash injection to stabilize things. But what about the panic, the loss of faith in the market? How do you fix that?
Yeah, the psychological part of a crash is huge, and the Fed knew that. So on top of the cash infusion, the Fed chair at the time, Alan Greenspan, made a very deliberate point of saying, the Federal Reserve, consistent with its responsibilities as the nation's central bank, today affirmed its readiness to serve as a source of liquidity to support the economic and financial system.
So in plain English,
Basically, he was saying, don't panic, we got this.
short, simple, to the point. Did it work?
It really did. Greenspan's words, coupled with the Fed's actions, they threw some ice water on that market fire. They reminded everyone that even when things look really bleak, there's a safety net, a backstop.
And just like that, crisis averted. Back to the good times.
Not exactly just like that.
Yeah.
There were still some aftershocks. The market remained volatile for a while. But yeah, the Fed's intervention did its job, prevented a complete and utter meltdown.
So a happy ending, relatively speaking. But what about the bigger picture? What did we learn from Black Monday?
Oh, Black Monday was a huge wake-up call. It exposed some serious weaknesses in the system, how easily these automated trading strategies could backfire when everyone's following the same playbook.
Kind of like what you were saying about portfolio insurance earlier.
Yeah, exactly. But Black Monday also led to some positive changes, like the introduction of circuit breakers in stock markets, these mechanisms that halt trading for a short period if prices drop too quickly, like hitting the pause button to stop that panic selling in its tracks.
So Black Monday forced some important safeguards.
Absolutely. But more than anything, I think Black Monday really highlighted how crucial clear communication and decisive action from policymakers are in a crisis.
That's a fantastic point. And for our listeners who might be thinking, okay, Black Monday sounds terrifying. Should I just pull all my money out of the market and hide it under the mattress? What are your final thoughts for them?
Black Monday was a scary event, no doubt about it. But the thing is, market volatility, it's just part of the game. It's not something to be terrified of. What's important is that you understand it, that you're prepared.
So don't panic, do your research, and don't make decisions based on fear.
Exactly. Black Monday, as scary as it was, it showed us that even after a massive shock, the markets, they can bounce back, recover, and grow over the long run.
That's a wrap on our deep dive into Black Monday. Thank you for joining us on this roller coaster ride through financial history. And remember, knowledge is power, especially when it comes to your money. Until next time, keep learning, keep asking questions, and keep exploring the fascinating world of finance.